Most people think billionaires are rich because they own expensive stuff: mansions, private jets, huge stock portfolios sitting in a brokerage account somewhere. That's not actually why they're rich, or more precisely, that's not why they stay rich, and it's definitely not how they operate day to day. The real secret is something far more boring and far more powerful: cash flow. Today we're breaking down why billionaires structure their entire financial lives around income they don't have to sell anything to get, and why that one shift in thinking is the actual dividing line between wealthy and rich. Here's the stat, well, really the mental model, that explains this whole video. Net worth and cash flow are not the same thing, and confusing them is the single most common money mistake people make when they imagine what being rich actually feels like. Net worth is a number on paper. It's the value of everything you own added up on a given day. Cash flow is money that actually moves into your account on a schedule, whether or not you did anything that day. A person can be worth $100 million and still be cash poor, and a person earning steady cash flow can live like a wealthy person while their net worth barely moves at all. Billionaires figured this out a long time ago, and it changes everything about how they operate. So if billionaires have all this wealth tied up in stock and real estate, why don't they just sell some of it when they need cash? Because selling triggers two things they're actively trying to avoid: taxes and losing the asset itself. When you sell an appreciated asset, you owe capital gains tax on the profit, sometimes 20% or more depending on where you live. Sell enough, and you've handed a huge chunk of your gain straight to the government instead of keeping it working for you. But here's the part that most people miss. Once you sell, you don't own that asset anymore. If it was a stake in a company that keeps growing, or real estate that keeps appreciating, you've traded away your future upside just to get cash today. So the wealthiest people developed a different playbook entirely. Instead of selling assets to get cash, they borrow against them. Banks will lend against a stock portfolio or a real estate holding at low interest rates because the asset itself is the collateral. That loan isn't taxable income because it's debt, not a sale, so they get spending cash without triggering a tax bill and without giving up the underlying asset. Borrowing against assets solves the tax problem, but it's not where the real cash flow comes from in the first place. That comes from owning something that produces income on its own, usually a business. This is the part that gets lost in most get-rich content online. A business doesn't just create a lump of net worth, it creates a recurring stream of cash that shows up whether or not the owner does anything that week. A well-run company keeps generating revenue while the owner sleeps, travels, or starts an entirely different venture. That's fundamentally different from a salary, and it's different from most passive stock holdings too. A salary requires you to keep showing up. A dividend depends on a company you don't control deciding to pay one, but an owned, cash-flowing business is a machine that keeps running because you built the machine, not because you're operating it every single day. Here's the insider concept that separates casual investors from people who actually build lasting wealth. It's called the multiple. When a business generates consistent cash flow, it becomes worth a multiple of that cash flow if the owner ever wants to sell it. Sometimes 5 times, sometimes 20 times, depending on the industry and how reliable the income is. So the cash flow isn't just spending money, it's also quietly building the net worth number in the background without the owner ever touching it. This is where we need to correct something the internet gets wrong constantly. Most of what gets sold online as passive income isn't actually passive, and it isn't actually what billionaires are doing. A rental property that needs a new roof, a course that needs new content every year, an online store that needs constant marketing, none of that is passive. It's a job with irregular hours disguised as an investment. Real cash flow wealth is closer to ownership with management removed. A billionaire who owns a stake in dozens of businesses isn't running any of them personally. They've built or bought systems, put competent people in charge, and collect the cash flow that results. The passivity doesn't come from picking the right asset. It comes from being far enough removed from the operations that the income keeps arriving regardless of what the owner personally does that day. That distinction matters. because it explains why so many people chase passive income ideas and end up with a second unpaid job instead of the freedom they were promised. So if this is such a clear strategy, why doesn't everyone think this way? Because our instincts about money are built around scarcity, not around flow. Most people are trained from childhood to think about money as a pile to protect. Save it, don't touch it, watch the number go up. That instinct makes sense when you don't have much, but it actively works against you once you're trying to build real wealth, because a pile that just sits there isn't doing anything for you. It's cash flow, not the pile itself, that actually changes how someone lives. There's also a psychological trap in the opposite direction. Net worth feels more impressive to talk about. I'm worth $10 million sounds better at a dinner party than I have $15,000 a month landing in my account whether I work or not, even though the second one is what actually changes someone's day-to-day life. Billionaires aren't smarter about money in some abstract sense. They just optimized for the thing that actually matters, flow, not the size of the pile, years before most people even learn the two are different. So here's the real takeaway. Net worth is the scoreboard. Cash flow is the game. You can have an impressive scoreboard and still be stuck, or you can have a modest scoreboard and total freedom because the money actually moves. That's the same principle behind almost every boring but wealthy business model we've covered on this channel, the ones that generate steady income quietly instead of chasing one big payday. If you want to see that principle applied to a specific business, check out our breakdown on Reference Your Relevant Economics of Owning video. It's the same logic in a completely different setting. If this breakdown was useful, subscribe. New economics breakdowns drop every week. See you in the next one.